Get ready to embark on an economic journey as we unveil the heartbeats of the Rwandan business landscape. This is the Business Age, your front row seat to the economic renaissance of the land of 1,000 hills. Join us as we traverse the bustling markets of Kigali, delve into the success stories of Rwandan entrepreneurs, and explore the dynamic forces shaping the nation's economy. From the boardrooms to the street vendors, we'll bring you the voices of the visionaries and the minds behind Rwanda's economic evolution. Discover the fusion of tradition and technology, witness the agricultural innovations transforming rural communities, and explore the cutting-edge innovations propelling Rwanda into a new era of economic prosperity. From the city lights to the rural landscapes, every business is a story waiting to be told. Hello there. Thank you so much for tuning in to today's episode of The Business Age. The African continent is surely providing opportunities for traders, for entrepreneurs to grow and blossom within the continent itself and across the globe. However, financing remains a huge issue and a huge challenge for these particular parties involved to be able to grow. On today's episode, we speak to different players within the financing space. We also speak to an SME to understand what is the current state and what are the challenges and what are the possible solutions to driving and closing the finance gap. You will be with me, Naringwa Fiona Mothoni.
Statistics are out there, and everyone knows that micro and small enterprises in Africa account for over 90% of the GDP, and it constitutes of 80% of all jobs. So that is actually where all effort by government or non-state actors should forward their efforts, or should put much of the effort, because maybe 1 cent that is invested in there, it's a great multiplier for the particular group that is that consists of the greater population. I would try to avoid the obvious tired example of access to finance, because that one is very obvious, but also matters formalization. Informalization in this sense, I mean making the businesses registered, and the compliance process is really tough and not very easy for young people, especially those who have an idea, an innovative idea about what they can show. Maybe I would even front the service sector. The service sector is one of those sectors that are under facilitated, if I would use that word. Under facilitated in the sense that no one believes that an idea can be financed and an idea can be used as a collateral for, say, a loan for a young person to improve themselves. So I would say formalization is a key problem, but also capacity in terms of improving from one level of the MSME to the other. And this, I mean, if a young person runs a small enterprise within a given country, say Kenya, for example, what are the aspirations, or what are even the motivation for this young person to even think of the next market in the neighboring country, say Uganda or South Sudan? Very minimal, because even within our own countries, they suffer lots of trouble with the compliance processes. So I would call upon our very esteemed governments to take some time and think about this, about compliance processes, about reaching out to young people or facilitating young people, because young people bring out themselves. Facilitating young people to an easy registration process and affordable registration process, and also having some mechanism of mapping out all the available resources for financing that young people can take up.
I will tell you from our point of view, is it working? Slow. It's very slow. We live in an era of digital technology. We live in an era of speed. We cannot afford to be slow. And so we must redesign, be innovative, redesign innovative solutions that will be able to fit in the pace of the era we live in. You know, presently, we are not satisfied with what the financial systems are doing for SMEs. We believe they can do more, and we are willing to work with them to achieve more for the SMEs.
I think the financial model works, but it can be scaled. And that's what we are actually looking to do with our partnership with governments, but also with development financial institutions. Back earlier in the year, we signed, for example, a risk-sharing agreement with the African Guarantee Fund for $205 million. The idea being to really alleviate some of the constraints that we may have from a capital adequacy perspective and be able to really do more. And similarly, we've signed agreement with AfCFTA, we've signed agreement with RTD, and we would continue to basically scale up what we can deliver. And the other aspect of what we can, where we can also help is obviously on from a payment perspective, because what we want to add as a layer of capabilities or solutions is some of the digital lending capabilities. Is basically, that Ecobank has created, for example, express accounts. Those are free accounts open to all SMEs. The idea being to help them formalize and for us to keep track of the collection and the sales. And behind this product, we want to be able to also put in place the digital lending, which will also allow us to scale up our lending capabilities to these SMEs.
I think we talk about trade finance quite a lot. And, I think we've, over the past few years, been very attracted to the big highlights of what the challenges are. So we talk about $100-odd billion of a trade finance gap. And in doing that, I think we sort of missed the point a little bit. I think we need to take a step back and, unpack what that gap actually looks like, right? Because if I told you that 90% of that gap was, international banks unable to confirm letters of credit, the execution of solving for that problem is very different from if I told you that 90% of that gap was SMEs in Rwanda not being able to access finance. Those are two different types of trade finance gaps. So I think, it's important that we take a step back, unpack the trade finance conversation, unpack the gap. And once we do that, we'll be able to provide solutions that tackle the specific areas of the gap that we want to tackle.
Interestingly, the 5 regions of Africa have a figure of 100 million SMEs and counting. Now, the documented figure of 100 million SMEs cater for women, for youths, for physically challenged or differently abled. So the conversation is, if Nigeria alone has 40 million plus SMEs, you're talking also of Egypt, you're talking about Ethiopia, you're talking about South Africa, and then of course 50 other African countries. So the real issue is, how do we provide support for the SMEs to grow? And the conversations around the AfCFTA is that it is the SMEs that will help accelerate the growth of the economy in an AfCFTA era. And if that is the case, it means that the SMEs are key ingredients for economic growth. And if the SMEs do not understand the AfCFTA, if the SMEs are not supported by finance, how can they embrace it? How can they make us enjoy the future of an SME, of an AfCFTA we're talking about? How can they help us in looking at quickly achieving the Agenda 2063, which is the Africa we want? So we are saying that SMEs need to be supported. African SMEs have shown that they are resilient, despite all the hurdles, they are resilient. And all what we need, we're preaching and advocating for an Afrocentric template of finance, which is going to be an alternative measure of finance so that our SMEs can attract funding for their unique purposes and unique businesses. Simply put, 55 African countries. Africa is peculiar, Africa is communal. The template being used today by the by the banks, all the banks are Western templates. They've been there for since colonial days. So they are not contemporary. They do not fit into what is today's reality. So how can the SMEs access funds?
20% of them are able to access financing from the large financial institutions, but then also looking at the sector itself, 90% of the players are informal. So then how do we navigate the second bit of it?
Yeah. Supply chain finance is, for me, one of the most overlooked things, and I think is one of our biggest, undoings, that we haven't been able to crack the code of supply chain finance in Africa. Every time we talk about SMEs, every time we talk about the inability to access finance, the same issues come up all the time. We're talking about collateral, we're talking about they not having, financial statements that make sense, we're talking about capacity building and so on. Supply chain finance is the way you finance businesses that look like that, all right? If you want to finance businesses in any other way, who have the financials and who have the capacity and everything, that's one way to do it. But the solution to financing SMEs who don't have all of these things is supply chain finance. And we all need to ask ourselves, everybody in the supply chain, from the big anchors to the local financial institutions, to the regulators, to the development banks, we need to ask ourselves why we have failed in executing a supply chain finance program which actually forms part of our biggest solution to SME financing. How have we talked about SME financing for years and still haven't managed to figure out supply chain finance? I think it's a huge panacea to solving for the SME finance gap, and all of us need to get together to find a solution to bring in supply chain finance into our market.
100 million SMEs in Africa access only 20% of finance from the banks. How good is that? How can the SMEs grow? So what we are talking about is an increased funding for them. We are talking about changing the templates. We're not talking about blended finance. We're not talking about patient capital. We're talking about a new model of finance.
We need to start looking inwards as African banks and try to think about how we can solve for that trade finance gap. What I'm saying is that African banks and the African financing business community need to come together and commit to 100 billion of intra-Africa trade financing over the next 2-3 years or so. And that's, you can't achieve anything that you're not intentionally measuring, right? So once we set this target, and all well-meaning financial institutions in Africa who claim to be African banks, who claim to be on the continent and are willing to serve the continent, to commit to the challenge and report on it. So every year when I take EcoBank or UBA or AFCE's financials, I should be able to see how much they've done in intra-Africa trade finance. And we put all of that together, and at the end of the 2-3 years say, we have been able to achieve 100 billion in intra-Africa trade financing, right? And I think that's a really good step in starting to bring the financial institutions that matter on our continent to be able to start putting money into the intra-Africa trade finance, and that's a really good place to start.
What are some of the risks associated with lending to these particular businesses?
Well, the risk associated, I think statistics would say that typically when a startup starts business, there's basically a shaky period of 2-3 years where maybe those startups would end up being closed or something. So that's the aspect. But my own view, the more prevalent risk is that of just governance, right? Because we need to really foster and help our SMEs formalize. And by formalizing and opening accounts, getting a track of what the payments are, that would facilitate our job as bankers to really, on the base of the sales on which we can get track, put in place those digital lending solutions.
There's a lot of risks. I mean, as an investment manager, you want to invest and get your money back, right? But also as an impact investment manager, my objective is to create as much impact and development in the investments that I make. And the risks are the same. The credit risk associated with the businesses that we finance, the market risks. We know the situation in many African markets now. But I think we look beyond that, right? I think when we're looking for impact, we look beyond those. And our objective is to go where we can have the most impact. And sometimes that means taking on a bit more risk. So we're not afraid of taking on risks. I think what we look out for is to setting out the transactions and the structures in a way that makes sense so that we can achieve the impact that we set out to achieve.
That's a question that everyone always asks. Are these MSMEs ready? But when will they be ready? If everyone would always ask a question of when they are ready, the issue here is let's all believe in the first place that MSMEs can. With that kind of an approach, then we'll be able to see an MSME is able to achieve 1, 2. They are not able to achieve the 3 and 4. So they are assisted to achieve the 3 and 4 that they are not able. But the blanket approach of the blanket doubt that most of us maybe put to MSMEs would be a wrong approach, which in most cases makes MSMEs have that bad name. But indeed, they are very capable. Even those big corporates of today, I want to believe at one point, they were small. And with little strides, they became big. Little strides meaning that there was an external support that came from somewhere. There was an internal effort, of course. So MSMEs, in short, need to be given facilitative environment. And this facilitative environment is both from government and the non-state actors, as I said earlier, about finance and facilitative environment for them to thrive and become established and grow.
Looking at partnerships, the role of partnerships, how can African countries and financial institutions work together to create a more unified, when you're looking at the trade finance infrastructure in itself?
Very critical. Cross-border movement of money. Obviously, we are in 33 countries as EcoBank, so we have the network and we can move money not only on a time-efficient manner, but also with a very little cost, right? Because the cost component is important. And so we have that advantage. And we have also signed the agreement with PAPS to really supplement our capabilities across those 33 countries. So we can really basically help on those payments and be able to leverage on those payments, but also on collection, right? Because when you get paid, it's important to get collection. We have what we call a Pan-African bank, meaning that through our Rapid Collect solution, the Rapid Collect is basically being able to collect all your sales within one bank account, right? And that, again, would help really foster financing because there's track record on what the business has been able to deliver in the past, and on that basis be able to really help and sustain the financing put in place.
No, it's also a very good place to start because, you know, for every SME, they will form part of an intra-African supply chain, right? Somebody will be buying inputs from somebody else in another country and selling whatever they've been able to produce to another country. Somebody will be hiring, you know, people from in that country to help produce whatever they're producing. So there will be a supply chain formed. And once the supply chain is formed, the way we execute on financing that supply chain is through simple supply chain finance procedures, invoice discounting, reverse factoring, and things like that. And I think if we focus on that as a first point, as a simple place to start, then we can actually put financing out there to these SMEs. And then once we figure that out, they would have by this time grown, become a bit more sophisticated, and then we can do other forms of financing. But you know, this is a supply chain finance, I tell you, it's the way to go, and we need to start doing more of it. There's a big connectivity there. I think when it comes to small and medium scale businesses, it only makes sense to use technology and digital infrastructure to scale the financing and to make it make sense, right? It's very difficult to ask for SME financing for a small cohort of SMEs. When you want to achieve scale, I think it's important to incorporate digital infrastructure. And there's a lot of examples out there on the market where people are doing that. Obviously, there's more to be done and so on. And so I think, again, it behoves on the financial institutions that are in market to work closely with, when you go to other markets like Nigeria and Ghana and so on, I think there's been a really good pickup of some of these things and they're doing well. Regulation has a bit to do with it as well. Sometimes in certain markets, there's the regulatory bar to get into using digital finance to solve for challenges like, SME finance is a bit high, and rightly so sometimes, but I think it behoves on some of these regulators to provide an atmosphere that allows, investors who want to come into some of these areas to be able to do so. So look, again, it takes a village, right? And this village of African businesses, of African financiers and regulators, we all need to come together and try to figure this out.
Across the continent, we have been able to map out new innovative technologies to support that speed, that access to finance for SMEs. Now, from the Afrexim Bank and AfCFTA perspective, they're talking about PAPS, which is the Pan-African Payment Settlement System. It's fair enough. It's been launched. Is it workable? Is it actually working? It's not working. Does it go across the continent? It is still a testing. It is a test period. It's a pilot. It hasn't been totally successful across 55 states in Africa. And so, what we can work with right now is a new approach through apps like M-Pesa, because everybody has a phone. You have about 600 million people in Africa using telephones or using the internet. So based on that, you can send money through MTN Momo. You have Momo transfers, you have M-Pesa transfer. So those technologies are rather fast, and they're being used by everybody. So what we are saying at our own level, we have leveraged technology to engage with a partner called NOC, N-O-K. So there's NOC Pay. So with NOC Pay and NOC technologies and a few other digital systems we want to launch and unfold from November 9th, we're going to unleash a new digital platform. And we're saying that we can leverage on technology to give us that fast-paced speed we want for SMEs to attract the funding and for them to be able to use the funds to grow their businesses. So technology is one thing to leverage on. Technology is working, and technology is working faster than what we are seeing with, unfortunately, with PAPS.
One, who's supposed to take the leading role? Is it the private sector? Is it the government? Is it creating a conducive environment? And two, how is the regulatory environment currently?
Well, private sector should keep on talking, because it is private sector that creates the jobs. Now, government and public sector is there to provide an enabling environment. So if you don't talk, they won't hear you and they won't make the policies. So they make policies and the enabling environment. And then private sector will keep on talking and private sector will now implement. So basically, I will tell you that the way it is, private sector should take the lead. They should keep. We are here because we are private sector. We're engaging because we're private sector.
Be able to really, make sure that all the forces of and all the institutions are really focused on really alleviating this, including regulators, right? Where we can really work together with governments to make sure that we really address that trade finance.
So you're able to have a feedback from private sector to feed into your policies and then give us enabling environment for the businesses to thrive. So private sector takes the lead.
How does
But government must listen.
How does an enabling environment look like? What policy should be put in place?
Enabling environment is omnibus. You're talking about security. You're talking about the right landscape. You're talking about taxing systems. You're talking about various. It's a humongous approach. But what is most important is all the landscapes are not. It's not one cap fits all. The landscape in Rwanda may not be the landscape in Zimbabwe or Botswana or in Egypt or in Nigeria. And so the landscapes differ, and the governments or subnational governments have various designs of engagement. But what is important is that they must provide the enabling environment. The enabling environment in Sudan, as it were, or in DR Congo, it's not the same as what is in Kenya or what is in South Africa. So because you have various landscapes, the governments must provide enabling environment, which is wide enough for you to look at the peculiarities of the particular environment that you're operating in.
No, I think, regulation exists to protect our financial systems, and it's a very important part of financial systems, and we need to respect that. But I think the other aspect of regulation is also to help grow and develop these financial systems. And I think sometimes the balance might be a bit off. And I think that's where, we need to, also from us as development partners, need to, make the right calls to these regulators to, help them understand and see how they can grow and expand regulations to be able to incentivize businesses to grow. We've talked about things like the, risk weighted assets of certain instruments in local markets, right? Some of these regulations are a bit westernized and brought into our local markets, and sometimes they don't work enough to our favor, right? So we need to take a second look at those types of regulations again. We can't have regulation that seems to stifle business. We have to have regulation that promotes business and provides the environment for the businesses to do well and thrive. And I think that's the conversation that needs to be had.
First of all, I would say capacity building. Capacity building is about, I would say maybe categorizing all those young people who are aspiring. There are young people who are aspiring to be entrepreneurs. There are young people who are already in business, and there are young people who are already in business and already doing it big. It's good to first of all have that categorization and then see where the capacity is more needed. Capacity building is more needed in terms of maybe market access, in terms of production and mass production, and also things like, for instance, branding or even packaging, so that products by young people can also be products that can compete in the market with those other products from giant companies. So capacity building is key, and also financing young people for the sake of production and for the sake of enhancing them, or rather encouraging them to trade amongst themselves, because young people are at least a third of Africa's population. So if young people could see the essence of trading amongst themselves, that already would boost intra-African trade.
There you have it. Thank you so much for tuning in and being part of this particular show. We were speaking on the financial challenges within the African continent and what needs to be done to bridge them. You are with me, Naringwa Fiona Mothoni. Until next time, stay well.